Hello everyone, welcome back. I got some really good ones for you today on this Tuesday, October 1st, 2024. A lot's been going on with the markets and current events. That's what we're going to be focusing on for today's video. So welcome back. Glad you made it. Glad we could hang out together. And let's dive right into this video, shall we? Starting with Hurricane Helene. Really bad, you guys. Category 4 hurricane slammed into Florida, Georgia, the Carolinas, Tennessee. 140-mile-an-hour wind gusts, storm surge, flash flooding, knocked out roads, bridges, infrastructure, millions without power, cell phone service. Complete catastrophe. You guys kind of get the idea. Last time I checked, the official death toll hanging out around 130 with an additional 600 missing. I do suspect the death toll will continue to climb as the missing people are found. I hope not, but just kind of looking into my hazy crystal ball. Some estimated $15 to $26 billion in damages, so really bad, you guys. Prayers to those affected. We also have a port strike from Maine all the way down to Texas, so East Coast all the way down to the Gulf Coast. Some 45,000 workers striking over automation, wages. A lot of market participants are saying this is going to be pretty catastrophic for the economy and have knock-on effects for markets. I'm not necessarily in that camp. It is something that I'm monitoring, but nothing that I'm letting inform my decision just yet. So, concerned about it, but not freaking out, not selling everything. You kind of get the idea. I mean, we shut down the global economy a few years ago and stock prices crashed straight up. So I'm not really sure that the port strike's going to do it, but, and I hope they get higher wages, We all need a higher wage, guys. Inflate or die. We got to inflate our way out of this. If we do that, we're going to be just fine. But as of right now, the only people that are eating are the rich and those that are out there, working for a salary or a wage. They're just getting killed by inflation. So hope the port strike results in a pay raise for those port workers. We really need them. That's a very sensitive part of the supply chain right there. And I hope they get the issue sorted out. But am I, running for the hills and super concerned about it? Not really for markets. Moving on to those markets, we have the 10-year yield right now hanging out at around 3.75%. Just banging around, pretty flat. Nothing crazy. When I look at the 10-year yield, I'm usually looking for a big spike in the 10-year yield, which means the bond bubble is getting smaller, and that can scare assets out to the end of the risk curve, like the three major stock indices or Bitcoin or gold. Or I'm looking for that 10-year yield to completely crater, which is money flowing into the bond bubble, making it fatter, usually giving those other asset classes the green light to inflate. But pretty flat day for the bond market. We do see the dollar, though, moving up about 0.5%. This is kind of putting downward pressure on those three major indices, along with the pop in oil and the increasing geopolitical tensions over there in Israel and Lebanon and between Israel and Iran. Saw last night Iran fire some 400 missiles at Israel, kind of freak people out. Crude oil moving up about 2%. Mega cap energy stocks following suit. ConocoPhillips, Chevron, Exxon all moving up about 2%. Gold also popping on that geopolitical tension and the rate cuts, putting gold at $2,675 per ounce. Silver also up today, hanging out around $31.68. Silver has yet to breach its 1980 high of $50. So I think that will happen in the coming months, years, business cycles. Silver will see over $50 an ounce, but right now hanging out around 32. So the S&P 500 selling off modestly, NASDAQ selling off a little bit more, Dow Jones pretty well flat for the day, dollar up 0.5%, 10-year yield flat, commodities like oil and gold moving up. It's those rate cuts and those geopolitical tensions. Got a JOLTS job data today. We have 1.1 available jobs for everybody who wants one. So, when Powell said yesterday that unemployment is around 4.2%, I do believe the Fed's unemployment numbers that they're kind of selling us on. I do believe that. I believe unemployment is very low right now. I believe that anyone that wants a job can get one. It's just a matter of, is that job going to be able to keep up with the inflation rate, the cost of capital, the hurdle rate? Is it going to keep up with all those metrics? Is it going to be able to keep up with that stock market that's just unstoppable and essentially crashing up? That's the real issue. So a lot of crappy jobs out there. If you get fired from a crappy job today, you can find another crappy job tomorrow. Unemployment is not really what I'm concerned about, and I do believe the Fed's unemployment numbers. Unemployment is pretty low. I don't believe the Fed's inflation numbers, though. I don't believe the CPI that's telling you that inflation right now is like 2.6% and that we're on our way back down to the Fed's target of 2%. I do not believe that for a second, you guys. And it's really hard for Powell to thread that needle, to on the one hand tell you he's confident that we're moving back to the 2% inflation target, while also cutting rates with asset prices at all-time highs. You know, guys, that's unprecedented historically. Normally, the Fed is waiting for an emergency or some sort of deflation and fear in markets before they come out and start easing. But this time around, we've started an easing cycle beginning of September with markets at all-time highs. And if you're gonna, you want my opinion, Fed's taking an already very bubbly market from years of low rates and zero interest rate policy. So we have this very bubbly market from years and years of cutting rates and keeping rates way too low for way too long, really destroying the value of that dollar. And what do they do when the markets are at an all-time high? Start destroying the dollar again, start cutting those rates again. So you got a bubbly market, and now you have a Fed pumping even more air into it, which is pretty unreal, you guys. Pretty crazy stuff that they would start an easing cycle with markets at all-time highs. But this is going to make, in my opinion, inflation just so much worse. So, unemployment is not what I'm worried about, but inflation is. Inflation is totally the boogeyman. So watch for that, you guys. So we had JOLTS job data today. We have ADP non-farm employment data tomorrow. Tomorrow. And then on Thursday, we have initial jobless claims. And then on Friday, we have the September jobs report. So a lot of jobs data coming out this week, you guys. We also have some Fed speakers this week. Had Powell yesterday at the National Association for Business Economics in Nashville, giving a speech. Sounded a lot like an FOMC meeting with a press conference, although it wasn't. The main takeaway from Powell's speech yesterday, you will see in your stock app yesterday, the three major indices kind of had a dip and then recouped all those losses and closed positive for the day. That dip was markets recalibrating expectations for a 25 basis point cut for November as opposed to a 50 basis point cut. So biggest takeaway from Powell's speech yesterday is that we're looking at 2 more interest rate cuts for 2024. They're each going to be about 25 basis points. Now, the Fed is saying we are data dependent, but if everything goes as to plan and the data comes in as expected, we can expect 1 25 basis point cut for November and then an additional 25 basis point cut for December. So 2 25 basis point cuts to finish out 2024. That's kind of what we're working with. Markets on Friday, we're assigning a 53% chance of a 50 basis point cut. That is now, as of last night, come down to about a 35% chance of a 50 basis point cut in November. So odds of another 50 basis point cut coming next month are waning, looking more like 25 basis points. But if you want my opinion, cuts are still cuts. I don't really care if it's a 25 or a 50 basis point cut. You're still cutting interest rates. You've still started the easing cycle. You're still weakening the dollar. You're still making the asset bubbles fatter, blowing more air into them when they're already, very bubbly. So onwards and upwards for risk asset prices. And I'm just hoping that wages and salaries can catch up and keep up with that, Do not believe that CPI, you guys, of 2.6% inflation. If you want my opinion, official inflation right now for 2024 is probably closer to 7 to 8%. The cost of capital, 7, 8, 9%. The hurdle rate, 10, 11%. You kind of getting the idea. The currency is being devalued at a much faster rate than only a 2.6% per year inflation rate. And even if we did hit the Fed's target of 2% inflation per year, after 10 years of 2% inflation every year, your currency has still lost 20% of its value. So even under the best conditions, we're looking at a 20% devaluation in the currency over the next 10 years. So that's best case, guys. But I'm looking at it being a lot worse than that. So the crisis is not unemployment. The crisis is inflation. And can your wage, can your salary catch up and keep up with that? Inflate or die, And Powell's always going to try to understate inflation because he wants to downplay how much is being stolen from Social Security recipients, pensioners, wages, workers. You're kind of getting the idea. Powell always wants to understate inflation and then continue to pump these assets, hyperinflate these assets into the stratosphere. That's kind of the game he plays. Downplay how bad inflation is in the dollar and then really stuff as much hot air into those markets as you can. China is stimulating. So China's, man, you guys, you think the dollar empire is leaky and dealing with a lot of inflation and stimulating aggressively? China, wow. So China does have some real deflationary issues that they've got to work with. They have an aging demographic. They have an oversupply of housing. That's really put downward pressure on like their real estate markets, sending their markets as of the last few months into a real tumble. But over the last few days, we've seen the Chinese stock market pop some like 20% in only 5 days. Insane. Looks like China's passed a $140 billion stimulus package with multiple rate cuts. So, whenever you start to complain that the dollar empire is easing too much, just look at some of these other countries, especially like BRICS countries, Brazil, Russia, India, China, South Africa. They're crazy with their inflation. So China's market's pretty volatile, something to keep an eye on. In the last 7 days, aid packages to other countries, you guys. Ukraine has received $8 billion in the last 7 days. Israel, $8.7 billion. Taiwan, $563 million, totaling $17.3 billion in international aid packages just over the last week. Said earlier that the estimated damages from Hurricane Helene were 15 to 26 billion. We just gave that amount to 3 other countries. So I'm really hoping we can send the billions necessary to the southeastern United States to help actual American citizens, as opposed to these countries that most of us couldn't even point to on a map. See what we got. Anything else? Really covered everything, you guys. Kind of talked about Powell's meeting yesterday, what that kind of did for markets, recalibrating interest rate cut expectations going into the end of the year. We talked about these rising geopolitical tensions between Israel and Iran, talked about Hurricane Helene, talked about the stimulus in China, the port strikes. Really covers it for you guys right now. Kind of gave you an idea of how the markets are reacting to all this. So that's really all I got for you guys for right now. Hope this video finds you doing well. Like, subscribe, comment, share, whatever. You guys are awesome. Drop a comment. Let me know what you make of all this madness. And we're just going to keep going, all right? Till next time.